Money is the root of all evil. Money can't buy happiness. We've all heard of these sayings, but only one thing remains true. We all want money. Hey everyone, welcome to day 6 of our 30-day posting about finance content and studying journey. Today we're going to talk a little bit about financing and venture capitalism. As we said earlier, startup CEOs are pretty much generally broke people. They are not rich billionaire CEOs or people who have rich billionaire daddies who can dump a ton of money into getting their startup idea, their business idea funded and up and running. Startup CEOs do have to go up to a venture capitalist and ask for money. Funding your operations or funding your business plan and to get your business up and running requires a lot of capital, and it happens in a few stages. The first of which is called bootstrapping, which is when you get your personal paycheck. You might use your credit card loans and stuff, generally to get your own personal involvement, your personal stake within the business to purchase whatever equipment you need, and to get your business up and running. You might even borrow from friends and family. Bootstrapping is tying in all of your personal connections and getting your own money involved so that you can get your business up and running. Then after bootstrapping, we have what's called a seed stage financing, which is when you start to actually ask venture capitalists for money. We also have this thing called an early stage financing, which is also asking venture capitalists for money. But the difference is that for seed stage, you're trying to finalize your business idea, your business plan, your model, and you're trying to build a bunch of prototypes, your MVP. Business key term of the day, MVP means minimum viable product. But the difference is for seed stage, you're trying to get your MVPs and your prototypes up and running, whereas for early stage, you actually have your idea done and finalized, and you're trying to get it up and operational. But the more important part, the final stage, which is also called the exit, is when, and also hence the word exit, the venture capitalists try to leave. And usually if the business is successful, it's very, very profitable for the venture capitalist. So the venture capitalist will either sell it to a strategic buyer, which can be somebody who works at a private equity firm, or sell it to a financial buyer, or selling it to the public via an IPO, which we will talk about later. I just want to know, in terms of venture capitalism, they usually last between 3 to 7 years for the venture capitalist before they try to exit the business. And this way, they don't stay involved in a super long-term stake. These people are usually called angel investors, so they specialize in investing in in startups and sort of helping them to push towards that unicorn and that decacorn phase. A unicorn means $1 billion startup. A decacorn means a $10 billion plus startup. And note that generally, financing through a venture capitalist raises equity. They get an equity interest. There can be debt interest as well, but generally speaking, people raise it through an equity interest and they share a stake with the venture capitalist. And it usually starts at a preferred stock, giving them the ability to convert to a common stock in the future. And the difference between a preferred stock and a common stock is that preferred stocks tend to get all the dividends first, and then a common stock, even though they're the last people to receive dividends, if at all. But the difference is that the common stockholders do have voting rights and they have stake in what the business makes decisions on in the future. So the venture capitalists generally tend to have the ability to convert their shares in the future. Now, there's a few things that a venture capitalist will do to hedge off the risk. Financing in different stages, so not giving them $100K at once. They might give you $10K each year until it becomes something bigger. They also might require that the entrepreneurs themselves have a personal stake in it, so that they're not just toying around with other people's money. And they also might do what's called syndicating investments, which means getting multiple venture capitalists together and selling off part of that equity so that they have a lower stake, but they also have a lower risk involved. Usually venture capitalists don't have this information barrier that banks do, right? Banks specialize in the finance sector, but if I'm starting up a tech company, I might not understand, for example, nanotechnology or a COVID vaccine as much as a venture capitalist who specializes in that industry does. And that's why it's so much easier to just work with venture capitalists who have specialized experience than to finance through the bank. Now, what does an IPO mean? An IPO is an initial public offering, and it's when the venture capitalist wants to exit, and they exit through the public market or the public secondary market. So what usually happens is investment bankers will help do what's called this thing called underwriting. Underwriting and origination and distribution. So origination is basically preparing the company to go public, to sell and trade their shares on the common exchange, for example, NYSE or NASDAQ. An IPO basically makes the company go public, and there's a lot of different factors that do go into an IPO. So origination, part one, is basically when the firms decide to go through an IPO, where they file a bunch of like a registration with like the SEC in the United States or the Securities Exchange Committee or something like that, whatever it stands for. And then they get the investment banker to help determine what a good share price is, whether or not it's ready for an IPO, and they give a lot of financial advice and basically prepare the company to go public. The important or the risk-bearing part of an IPO is what's called underwriting. Basically, underwriting is when the investment banker or the investment bank will purchase shares of that company or from that venture capitalist, whoever it may be, and then resell it to the public. So they do it in two different ways. There's one that's called a best effort basis, where they basically go like, oh, we're gonna try our best to sell your shares for as much money as possible. No guarantees though. Or number two, a firm commitment basis, which is when they say, okay, we're gonna guarantee, let's say your stocks trade is a good price to be traded at $30 per share. We're going to give you $27 per share, and we're going to take a $3 share commission to make this underwriting spread possible, right? And they sell it back to the public. That's what underwriting does, right? They basically like determine the share price, and they like purchase every single share that's going to be sold on the public exchange and then sell it to the public. The last thing that we need to understand is like distribution, which is basically after all of the due diligence meetings and final offer price is determined, all the preparations, the investment bank does everything and actually sells it to the public. Sort of understand, there's a few benefits and drawbacks to having an IPO. The benefits to having an IPO is that there's going to be a lot of equity amount, right? There's going to be larger equity amounts because you're going to create a lot more shares for the public. And additional equity can be raised at a lower cost because you've filed everything with the SEC, you paid all your legal fees, you've done everything. So it's a lot easier to raise more capital within the future. And you can also fund a growing business without giving up too much control, because you're going to be getting a lot of money for the shares on the public exchange, right? It also creates a secondary market for trading, and it's easier to attract top management or to motivate the current managers within the company. It also allows for an exit for both like shareholders, maybe even the CEO wants to like give up control and hire new CEOs and stuff like that. They're going to be able to have this exit path through the initial public offering. And this is generally where the venture capitalists tend to like leave. Now, there's going to be a few drawbacks to an IPO, right? So what are some of them? Well, because of the fact that you have to follow a bunch of restrictions and requirements and formatting, you're going to have to create financial statements which are required for your shareholders to see because of this like full disclosure principle, where you have to let everyone be able to see everything and be very, very transparent. So like this is just an exercise. If you want to like just look up Apple financial statements, you can find like how much money Apple is making. You have to give up a lot of information which can potentially help your competitors outcompete you that are on the private market. Also, doing an IPO is very, very costly because you have to pay out-of-pocket expenses for like your legal fees. You've got to pay your underwriter spread towards all of the people who are like underwriting with your investment banks. And there's also this thing called underpricing, which is like you want your IPO to be successful, so you undervalue your stocks in a way that allows for your IPO to happen successfully, but that means you also lose out on the opportunity cost of making more money with your IPO. It's very, very costly in general. You're going to have to do a lot more work, you're going to have to hire a lot more people, you're going to have a lot more costs, and your competitors have access to all the information. Also guys, this is today's stock portfolio. It's doing okay, but yeah, yep, that's it. Thank you for listening to IPOs. I wanted to keep this episode very, very short, so enjoy IPOs, and I will see you for day 7 tomorrow. Good night.